Hey everyone, Coach Investor back to another video for today. So let's talk about the three companies I think you should have in your portfolio, especially when we think about the next big bull market. Now you might say, what do you mean next bull market? Look at the first 8 months of 2023. Isn't that good enough for you? Well, while I agree that the first 8 months or 7.5 months of 2023 were very, very good, you also have to take into consideration that 2022 was a very bad year. Some stocks were just oversold by a lot, and so that's why you see the huge jump in 2023, and you also see a huge jump in revenues, in earnings per share, in free cash flow for many of these big companies. For example, Nvidia, right? I fully expect them to generate $50 billion in revenue for fiscal year 2024. I fully expect them to beat and raise. By the way, earnings are today. We'll cover that on this channel. And no, this is not one of the three companies. But you're starting to see that in tough times, good companies become just better companies. And when we go out of the tough times, when interest rates will peak and then the cuts will start, you will see suddenly a reacceleration of growth across the board. Not just for software companies, because, well, growth there has been non-existent, right? We've seen that with many software companies lately. But overall, you will see people spend more to grow their business and be a bit less focused on the bottom line. Because in tough times, you have to focus on the bottom line. You have to see that, well, you're not closing shop. You don't have to lay off many employees because you're forced to. You're laying off because you want to become leaner and survive during the tough times. And so all three companies are pretty popular. Two of them are already very big ones. One of them is still a pretty small, sub $10 billion in market cap. I've talked about this a couple of times. And yes, I am biased since three of those companies are in my portfolio, but I do still think there is quite a lot of upside in all three of them. Of course, do share your three picks down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. So company number one is a no-brainer for me, especially with the recent price action. And that's my number one position also in my portfolio for quite a while. And that's Tesla. Oh, surprise, surprise. Yes, very surprising. But I mean, even though if you look at the traditional valuation metrics, right, PE close to 60 times in the next 12 months, EV to sales 6.4 times. But with a market cap of $737 billion, if you look at their growth rates for sales and EPS, I mean, in my opinion, this is quite remarkable. If you can continue to grow sales year over year, over 25%, these are the estimates here. And EPS, yes, for fiscal year 2023, EPS estimates are down 15%. But then after that, 2024, reacceleration, 42% growth. In 2025, 28% growth. I mean, these are the types of companies that you will never see at a cheap valuation compared to, well, other companies out there where you're looking for a PE of what, 20 to 30 times. You're not going to find this with companies that are growing this fast. And now specifically to Tesla, we obviously have some catalyst. I made a small joke on X. You can follow me there if you want. But here, Tesla will start delivering revamped Model 3 in China at the end of September. This is coming from a report. Currently, one of the salesperson there is saying that their main task is now to sell the Model 3 and Model Y with reduced prices. But there is still a lot of customers who choose to wait for the new model, even if it could become more expensive. In my opinion, it would be strange if the new Model 3 would be more expensive because the whole shtick of it is for it to become less expensive and so higher volumes and also better margins as well because they've figured out the manufacturing there. So stay tuned for that. That's a big catalyst. Obviously, the Cybertruck launch is going to be a huge catalyst as well, and the energy side of the business. Because apparently, 6 Chinese companies were among the top 10 global energy storage system supplier in the first half of 2023. And guess who's number one? Well, that's Tesla. Is that surprising to you? Well, not really, especially not if you look at their latest earnings report. Energy storage deployment increased 222% year over year. Of course, if we look at solar, that one is still declining, still struggling. Let's wait and see if the new changes there when it comes to working with installers. Let's see if that works out for them. But overall, don't sleep on Tesla's energy side of things because I do believe that it will become as big, if not bigger, than the automotive side. Of course, right now, contribution-wise, it is still smaller than the car part of the business. But over time, I mean, the growth rates there are much bigger than the automotive part of the business, so it's only a matter of time until it will have meaningful contribution to the overall Tesla business. And then quickly looking at the graph right now that I'm making this video, pre-market the stock is down around 2% or so, and the cup and handle pattern is following up pretty beautifully. On Saturday I said we should see a little rebound here, and that's exactly what we're seeing right now. We are currently on a weekly at a green candle, of course with Nvidia reporting. If it's a bad report, which I doubt, I think the whole market will go red, but currently cup and handle pattern is working out quite well. RSI is still neutral, MACD is now turning bearish. And so as always, I'll repeat myself, I rather buy into a company or add to a company when the market is red. Because when the market is green and you open a position, right, the stock is up 2, 3, 5% on the day, suddenly your margin of safety is down, even though, right, in the longer term, it doesn't really matter if it's 2 or 3%, doesn't really matter. But psychology speaking, you would rather buy when the market is red, because then you feel a bit better already if the next day the market is green. If you buy on a green day, the next day it's a red day, more times than not, retail investors tend to regret their decision, so they sell and then wait for a better opportunity, and the moment they sell, suddenly the stock goes up, they buy it for more, and so on and so forth. So always look for better opportunities. There will always be a red day. And now company number 2 is a company I've talked about not so long ago. Yes, a year or two ago, it was a very hated company because of everything that happened, and I'm talking about Robinhood. By the way, if you are following on X, we did a spaces talking about Robinhood, and whether or not Robinhood currently at $10 is just too good to be true. It's a spaces that went for close to 2 hours or so, went over the good and bad things, and to be honest, we didn't really manage to find that many bad things when talking about Robinhood, especially not at these prices right now. So talking about risk reward here, in my opinion, the reward is much bigger than the risk. And I'll already tackle the couple of comments that are already being written right now, talking about, oh, but people hate Robinhood because of the GameStop and AMC scandal, etc., etc. Now, while I agree that what happened was horrible, right, should have never happened, I doubt that that's what the majority of the people are thinking right now. And by the way, most people don't even know what happened, if we're being honest. If you're not on Twitter or X or on Reddit, you probably have never heard of this scandal. And that said, if you look at how the business has been performing, I mean, you would say, I think not a lot of people care about what has happened before. Because if you look at the latest earnings report, right, you can see here monthly active users is down. I'll touch on that in a second, 10.8 million. But then asset under custody, $89 billion, up 13% quarter over quarter. Net deposits, 4.1 billion. That's a 21% annualized growth rate. Total net revenue increased 10% quarter over quarter. Adjusted EBITDA over 31% growth quarter over quarter. GAAP net income is positive $25 million and earnings per share of 3 cents. Now, if we scroll down, by the way, when we talk about Robinhood, of course, a lot of people still think, yeah, it's all about transactions, etc., etc. But if you actually look at the business right now, in a high interest rates environment, they are making quite a lot of money with net interest revenue. I mean, when you are a company that has a significant cash pile, with over $6 billion in corporate cash, you are enjoying this market situation. Now you might say, okay, but what happens when interest rates will go down? Well, yes, when interest rates will go down, then probably growth will start to pick up and you'll see transaction-based revenue go up as well. But I still believe that the overall business today, especially if you look at average revenue per user, that has increased as well. They are growing, they are adding more services. You can see this with advisory that will be coming in. You can see this with Robinhood Gold, the retirement plan as well. So this is a part where you don't really have to be active if you are opening up a retirement account on Robinhood, right? The thing there is not to be so active. You can max out your Roth IRA and then, I don't know, when you're 60 or something, you can touch that money tax-free. So yeah, of course, you're not going to be that active as someone who trades, I don't know, AMC, GameStop, etc., etc. But the overall business is becoming more robust. I'm not even talking about the expansion in UK that will happen later this year because that's TBD. the overall business is way more robust than you think, and especially at current valuation. I mean, $9 billion in market cap or something like that, cash pile of over $6 billion. I mean, doesn't really make that much sense. Now, touching on the monthly active users, yes, that's one of the red flags that I did mention during that spaces. I do think that if this metric continues to go down, which I don't think it will, because we already had the July metrics, and in July there were 11 million monthly active users, so a nice little 2% jump month over month. But you can see that the rest, the important metrics here, total assets under custody increased 6% month over month, cash sweeps 7%, gold cash sweeps 7% as well. So things are trending into the right direction. The only problem here is that the stock right now is stuck in a weird situation because of this. So Robinhood moves to buy back $550 million of shares bought by Sam Bankman-Fried, the FTX guy. This was back in February. But since this is still in the custody of the DOJ, it remains to be seen when Robinhood might buy back those shares, or if it suddenly gets dumped on the open market. Because if it does get dumped on the open market, then it will put additional pressure on the stock. If Robinhood can use their cash and just buy their shares back like that, I think that's when you'll see the stock suddenly move on the way up. Of course, I might be wrong, and by the way, this is for me not a core position in my portfolio. This is for me a 6 to 12 month trade, because I do think that right now this is just a no-brainer. But if you see other red flags, do let me know down in the comments below. Now, company number 3, and that's the second largest position in my portfolio, and that's the one and the only Amazon. Now, with Amazon, I know what a lot of people will say. Amazon, it's already over $1 trillion in market cap. I mean, what are you talking about? How much more upside can there be? Well, I think there could be a lot more upside when it comes to Amazon. I mean, yes, I agree. $1.38 trillion in market cap, forward PE 55.8 times. Okay, not the cheapest, but if you've seen what has happened with the underlying business for Amazon, you understand why the analysts are expecting a lot of growth when it comes to EPS. I mean, fiscal year 2024, close to 40% growth, and the same thing for fiscal year 2025. Now, why is that? Well, because clearly the cost cuts have been working. If you look at operating cash flow, that has been going up for quite a while. So I wasn't surprised to see that suddenly free cash flow jumped from, well, in 2022 Q2, negative $23.4 billion to now $7.8 billion positive. And this is something that I've been saying for quite a while. Look at the operating business. The operating cash flow for Amazon has been going up for quite a while. So it was just a matter of time until you were going to see the profitability of the whole ecosystem, of the whole business. Of course, the cost cuts did help, but Amazon's business is extremely, extremely strong. Now, if you needed a small reminder, net sales online stores last quarter up 4% year over year, third-party seller services up 18% year over year, subscription services 14%, advertising services up 22% to now over $10 billion. I mean, this side of the business has just become extremely big, but don't sleep on the subscription one as well. And then, of course, AWS is what a lot of people are saying, oh, it's slowing down, it's losing lots of market share, it's only growing 12% year over year. Yes, it is down quarter over quarter. Last quarter, I believe it was 16% growth year over year. But I do fully think that this growth will just reaccelerate. Remember, the majority of IT infrastructure spent is still on-prem and not on the cloud. And AWS, if you put Azure and Google Cloud together, they're a bit bigger than AWS alone. And AWS is growing 12% at a run rate of close to $100 billion annually. So, I mean, come on, you're just making fun of yourself here. And looking at Amazon's stock today, we had peaked at just over $140. We're also a bit overbought. MACD is still bullish, but a bit trending down. As you can see, those two red candles here. Again, this week is a bit crucial because we're hovering between the 20 and the 50-day moving average. But to me, for the long-term future, you can really not go wrong with a company like Amazon. And I think a lot of analysts are suddenly waking up as well. We've had lots of new price target upgrades there, lots of talks with regards to Amazon becoming that next big player next to FedEx, UPS, United States Post Service, etc., etc. I mean, they've built all their infrastructure out for future success. So those are the 3 companies I think you cannot go wrong with at current prices. Of course, if you see a red day, I mean, it's much better than seeing a green day if you want to open or add to a position. So Tesla, Robinhood, and Amazon are my 3 picks for you today. Of course, do share your thoughts on all of those down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.